is, I guess, session number 7 of the KZN virtual classes. We are here to support you with accounting. I am going to be with Mr. Mdleje, who is going to be answering the questions on question and answer session or answer section on top here. And I am going to be dealing with the introduction of the analysis and interpretation of financial statements. And also, I will be doing the examination type questions that are normally asked in the exams for interpretation of financial statements. So this is a very interesting topic, as we all know. It's very interesting because this is a very important question. It is on question 3 on our paper 1, and it's very interesting because we are interpreting the financial statements. We're interpreting what they said in question 1 as well as question 2. So allow me to share the screen. Remember that you are encouraged to sign the register. When you see question and answer here, you will be able to sign the register. More students will be joining. I will remind you also to sign the register. Today, the paper that we are going to be dealing with is 2024 May-June exam, paper 1, question 3. So please download it, and we will be doing our own question paper. That is going to be done by myself as well. So welcome, and please do enjoy the lesson. It is going to be a lengthy lesson with more discussions, more explanations, because we want you at the end of this session to understand how to comment and how to interpret the financial statements. Okay, I've shared the screen. I hope everyone can see it. Okay, before we go straight to the analysis and interpretation of financial statements, it is better for us to remind ourselves of the ratios. The ratios. Where are these comments coming from? The comments, they are coming from the ratios. We call them ratios. But you must also remember that the calculations are done on what is called the question 2 with the cash flow. So in the cash flow statement, you are normally given also a section where you will be doing the calculations. But those calculations that you will be doing, they've got formulas, and the formula sheet is provided for you in the question paper for you to be able to deal with the ratios. But in this question that we'll be doing, interpreting of financial statements, they need you. It's not only about calculations, it is about understanding the explanation behind each and every ratio. I'm sorry about that. Explanation behind each and every ratio. Firstly, we've got group of ratios or of financial indicators. The group of financial indicators, firstly, we have what is called profitability indicators. Profitability indicators. Right? This is the first part. The one that we learned in grade 10. All right? In grade 10, we learned about profitability indicators. There are 5 of them altogether. Number 1, under profitability indicators, we've got the gross profits. Allow me to abbreviate to save time. We've got gross profits on sales. Gross profits on sales. That is the first one. Number 2, we've got the gross profits on cost of sales. This is also known as a markup. This is also known as a markup. We also have number 3, which is called operating expenses. Expenses on sales. We want to see how well the business is controlling their expenses. Then we also have number 4, which is going to be operating profits. Operating profits on sales. Then number 5, we have what is called the net profits on sales. Now, these indicators are very important because they tell us about profitability in the business. How profitable are we in the business? Because looking at the income statement alone will not assist us to take decisions. The income statement will have figures, the amounts, That we made sales of this much, we made cost of sales. Normal, we have got these expenses, we made this gross profit, this net profit. But those figures are not telling anything about the business, and they are not comparable with the figures of the previous year. That is why these indicators are important, because they are all in percentages. Lama indicators lab. So they are all in percentages under profitability. So it will tell us what percentage of gross profits do we have on our sales, so that we can be able to compare it with our gross profit on sales from the previous year, and we see whether the business have got an increasing trend or a decreasing trend when it comes to our profitability indicators. Wait, take this as in your school, we have exam session, as it is June now. You are writing exam papers. Your teachers will mark your scripts, and then they will give you back your scripts with your marks, what you got out of 150, and so on and so on. They will give you those results. But those results, they don't say anything to the school if they are not analyzed. Because after analyzing those results, the school will be able to take decisions about the result that you got, maybe in accounting. For example, I will see, no, many students are getting below 30%, or many students are getting below 40%. So it means that I must take decisions such as I need to see my students on weekends. I need to do this on this particular day. I come up with the intervention strategy. Now, in the businesses, they use these indicators so that they can take decisions that will shape the direction of the business in the future. Those results that you are going to get in schools, they are also used when the business want to award the students, the top performing students. So they are important to analyze the results of those students as well. In businesses, we use these results as well in order for us in the business to say we have achieved our target markup, which is gross profit on cost of sales. We will need to calculate the percentage of the gross profit on cost of sales and compare it with our target markup. For us to say we are managing our expenses well, we will have to compare the percentage we got this year and the percentage we got last year, and we will be able to see whether we can be able to take decisions in regarding our expenses in the business. If, for example, our expenses last year it was 18%, and this year it's 25%. Operating profit on expenses. This is 2024. This is 2025. Just making an example with these years. All right. 2024 we had 18%. 2025 we have 25%. Now you see that operating expenses on sales increased to 25%, which is bad for the business, because it means that now they've got more expenses. They have more expenses. That is why this is bad. So we want our expenses to decrease at all times. So this is profitability. How well or how profitable are we in the business? That profitability indicators. And then we also have what is called liquidity indicators. Liquidity indicators also, we have about 6 indicators here under liquidity. So if the question paper asks you to comment on the liquidity indicators, these are the 6 indicators that I will list here that you are going to comment on. Now, before you do this, comment on these liquidity indicators, what you need to understand is how they are calculated and what do they mean in the business. You cannot comment on something that you don't even know what it means. All right, let's start with liquidity indicator. The liquidity indicator color. The first one will be current ratio. Liquidity indicator, the first one will be the current ratio. Current ratio, how it's calculated, I will show you the formulas when we go to the other page. The current ratio is testing our current assets our current assets. This current assets, this is the formula, is to current liabilities. What is this testing? Can the business be able to pay off their short-term debts, which is their current liabilities, with the short-term assets that they have? This is the question asked by the current ratio. Then we also have what is called the acid test ratio. Acid test ratio. It also falls under liquidity. Acid test ratio also is more or less the same as current ratio, because also it is testing whether we can be able to pay off our current liabilities with our current assets but without stock. This is why the formula says current assets minus inventory. Why am I saying inventory? Because inventory is your stock. So minus inventory, and then your formula will be is to current liabilities. I will also explain the formula as well as the explanation. So I'm just listing here what we have under liquidity indicators. Number 3, we have got stock turnover rates. We've got stock turnover rates. Now, I want to check here in the business, so how fast in the business are we changing our stock? Hence, we have the rate here, turnover rates, the stock turnover rate. How many times did you change our stock in a year in business? I will also show you a formula with this one. Number 4, we have the stock holding period. Stock holding period. Right? This is also how many days. This will be in days, this one. So that means your answer here must be multiplied by 365. How many days do we take to sell the stock that is on hand? Right? So in most cases here we use average stock here and here. So in our formula you will see it when I'm projecting it. And then number 5, we have debtors collection period. Remember, sometimes we give our debtors 30 days to pay. Debtors collection period. We want to test here if our debtors are complying with our credit terms. So debtors collection period, they should be in days. If you say period, then your answer should be in days. And then number 6, which is the last one, will be the creditors. The creditors payment period. The creditors payment period. Right? How long do we take to pay our creditors? The answer also should be in days as well here, right? These are the 6 indicators. We don't see debt equity here. Many students, they just quote debt equity when the question asks them to comment on the liquidity indicators. You shouldn't quote debt equity here. I know it sounds like it's the same because of the rhythm, liquidity and debt equity. No. Do not quote debt equity under liquidity indicator because it doesn't fall under liquidity. These are the indicators that fall under liquidity indicators. So not ubani debt equity ratio. I've seen many students quoting debt equity ratio here. The other one will be solvency. There will be solvency. So here, solvency is just one indicator. It's solvency. Its name is solvency, which is checking whether the business can be able to pay off their total liabilities. Now, not only current liabilities, but total liabilities. The formula is total assets is to total what? Total liabilities. Total assets into total liabilities. We want to see whether we can be able to pay off this with our total assets. So at all times, our assets, to say we are solvent, our assets should be greater than our total liability. We cannot have our total liabilities greater than total assets. In that case, we will say the business is insolvent. If the business has got more liabilities, but it's rare cases where you will see total liabilities greater than total assets. It will be in rare cases. Mostly, this indicator, maybe it will be 3:1 or 4:1 or even 5:1. So we'll say the business is solvent. Means that the business, when they are owing, for everyone rent that they are owing in their total liabilities, they have 3 rents to cover their total liabilities. So it means that the business is solvent. So anything happen to the business, they will be able to pay off their liabilities because they have enough to cover the liabilities. Assets 3, liabilities 1. So this is solvency indicator. The other indicator will be risk, right? Under risk, we only have one, which is called debt equity. Now you see that debt equity is a standalone ratio. It doesn't fall under liquidity ratios. So it's a debt equity ratio, which checks the risk of of the business here. Sometimes this is called credit worthiness. It checks credit worthiness in the business, right? Now, when I say check credit worthiness, in the business, are we not financed in kakhulu by in ama loans in the business? Where is the risk here? The formula here says debt is to equity. Debt is to equity, meaning that it will be your loan or your non-current liabilities is your shareholders' liabilities. Is your shareholders? Oh, sorry, shareholders' equity, not liabilities. Is your shareholders' equity. So your loan is your shareholders' equity. As it is saying, debt is to equity. Now, this one must be less than shareholders' equity because shareholders' equity is our own capital, right? So our own capital here should be 1. Now, if we have got now here 0.6 is to 1, that's when we are going to say we have in Lapana a high risk, or anything above 0.5 is 1. We say we high risk from 0.5, 0.6, and upwards. We say there is high risk, but we are going to do it when we are answering our questions, so that to see how we comment on debt equity ratio. But you must remember that debt equity ratio checks the credit worthiness of the business here, right? Can we continue to take more loans, or we can't take more loans because maybe we have high risk and so on and so on? So we want this ratio to be 0.4 is 1 or less. Should be 0.4, 0.3, 0.1, 0.2. So when it is 0.4, 0.2, we say there is what? Low risk. There is low risk. Lapayana. We debt equity ratio. Okay, I hope we are still following with these indicators that I'm doing here. I'm still, if you just joined now, I'm still going to show you formulas and also what do they mean, Lama indicators. Because before we comment, before we interpret, we must interpret what we know. All right. Then we also have return indicators. Return indicators or ratios. Lapayana, right? For example, for now, I'll just speak about Uroshe, which is return on shareholders' equity. Return on shareholders' equity. Now, under return on shareholders' equity, here we're checking if it is worth it to invest in the business. This is why this indicator must be compared with what is called interest on investment or interest on fixed deposits. So I'm saying here this ratio checks whether the owners of the business, which are the shareholders, are they going to be satisfied with their investment in this business? I'm saying here that is why this indicator must be compared with the alternative investment, which is the interest on fixed deposits. Remember, our shareholders, they decided to buy shares in our business, okay? Now, here this ratio wants to check on the shares that our shareholders bought. What is it that they are getting? So, for example, they are getting 18%. That is the return that they are getting in our company. The return on the shareholders' equity based on how the business is performing. Now, for example, the ratio, the ROCE, Lapayana, the formula will be net profit after tax divided by average shareholders' equity. Then you multiply it by 100 to get a percentage. Now, if it's 18% and you find out the interest on fixed deposit is 10%. Now, this means it's better to invest in this business. Shareholders here are going to be satisfied. Why? Because the business is giving a return of 18%. But if they decided to invest in a fixed deposit, the banks in the fixed deposit was going to give them 10%. I'm not sure if you understand what I'm saying here. I'm talking about Uroshe. Uroshe checks the return on the shareholders' equity. The return on shareholders' equity formula is the net profit over average shareholders' equity. Then you multiply that answer by 100 in order for you to get a percentage. And then I'm making an example here to say the return on shareholders' equity was 18%. Now, if the return on shareholders' equity is 18%, and then the interest on fixed deposit is 10%, because this one is called alternative investment. Into alternative kahle kahle isho ukuthini lento le, enye indlela lama ama-owners noma shareholders wethu abenga-investa ngayo. Ama-shareholders wethu could have chosen to go to the banks and invest their money in the banks through what is called the fixed deposit. Now, if a fixed deposit is giving them 10%, and then Tina in the business, we're giving them 18%. Are they not going to be satisfied with their investment? They are going to be satisfied because we are giving them more, and in the banks, they were going to get only 10%. But things will change. When Tina, we made Ubani 9%, we gave them 9%, whereas the banks was going to give them 11%. In this case, we will say that our shareholders are not going to be satisfied, because you see, Uguti, Tina, in the business, we're prepared to give them Noma. When we calculated, we got 9% as Uroshe. Kanti, when we are commenting and then we compare this with the interest on fixed deposits or the interest on alternative investment, we are getting 11%. So our shareholders are not going to be satisfied with this. They are not, because our business is giving 9%, and then the banks was going to give them 11%. And we also have what is called ROTE. ROTE. I call it ROTE. I'm not sure what your educators call it in schools, but I call it ROTE to compare it to distinguish it with uroshe ngaphezulu. So ROTE is return on total capital employed. How well are we, or how effective or efficient we are making use of the loans in the business? That's what this indicator is checking. How effective are we making use of the loans in the business, or the capital employed? So the formula here for this one, as we all know, it will be the net profits before tax plus interest on loan over total capital employed. Wakiwa yini ke total capital employed? Total capital employed. Wakiwa yini? Total capital employed is made up of shareholders equity plus your loan. This is your total capital employed. But when we want average total capital employed, it means we must then add shareholders equity of the previous year plus of the current year, loan of the previous year plus of the current year. All this must then be divided by 2 to get average capital employed. So that is the formula. So I said this one checks, are we using our loans efficiently in the business now? So this is why the Mrs. Comment, right? We are going to be given, for example, Uguti, we have 18%, right, of our ROTE. And then it must be compared with interest on loan, must be compared with the interest on loan. This is what we are paying in the banks. This is what we are making with the borrowed capital. We are making 18% with the borrowed capital. But how much are we paying back to the lenders, right? Maybe we are paying 12%. So are we making positive use, a good use of these loans? When you check here, 18% minus 12%, you get 6%, which means we are making good use of loans because it's positive, 6%. That is why we will then say we got it shows in a positive gearing, because when you take your ROTE minus your interest, you get a positive number of money of 6%. So we have got a positive gearing. So which means we are making good use of loans here. That's what this indicator is saying. ROTE. I remember there was a question which asked about the limitations of ROTE. I can't remember, Mr. Mdletu, which question was that one. I can't remember which spoke. Oh, it was the May-June 2026. Please do check May-June 2026 question on this one, which asked about the limitations of ROTE. ikuphi la angasisizi khona ngalutho ubani uRothe. I forgot the phrasing of the question, but look at this one here. I said uRothe was 18%, interest on loan was ubani 18%. This simply says ukuthi wena you borrowed money, also you call an interest. Now, when you borrowed money, you want to make more money. You might want to make good use of it. So what is the return that you are getting? So we have got 18% that we got back, but we are paying back 12%. So we are making plus 6%. So it shows positive gearing. But if Tina Lapayana we got 10%, whereas our interest on loan was 12%, you would say 10 Rothe minus 12. This is going to give you negative 2. That is why you will say you have what? Negative gearing. Negative gearing. We got negative gearing. We are not making good use of loans. We are making lapana uRothe wethu it is 10%, whereas the interest on loan that we are paying is 12%. So we are not making good use of loans. That can be a comment, but you will see it when we deal with the actual questions. Under return indicators, we also have things like your EPS, your earnings per share. Now, earnings per share, this is your net profits per share. Your net profits after tax, all right? The moment it says per share, then you must divide by the number of shares. The number of shares. Ask your teacher again to assist you, Lapayana. It's not all the time where we divide by the number of shares at the end. Sometimes here we divide by the weighted average number of shares. Please allow me to explain what I'm saying now. The weighted average number of shares. Allow me to explain it towards the end of the lesson, because I might confuse or I might take a little bit time if I try to explain the weighted average number of shares. But if you check your formula sheet, check it now if you have got an accounting paper in front of you. Check your formula sheet. Your formula sheet has got there is a specific something which they are saying, Lapayana, in case there are changes in the number of shares, weighted number of the weighted average number of shares is used in practice. I'm going to check. They are talking about when you're calculating EPS. Let me not confuse you. So, but please write it down somewhere. Weighted average number of shares. Okay. Then we also have dividends per share. Dividends per share. Right? DPS. Now, you take your dividends, dividends divided by number of shares. Right? But this one will not give you what you want, dividends. That is why I encourage students here to calculate this in 2 separate questions, which will be your interim dividends. And if your interim dividends is issued on a particular number of shares. So you take your interim dividends divided by number of shares that were there on the register when you issued interim dividends. So it will be interim dividends over number of shares that were there. Then plus final dividends over number of shares that were on the register when we issued final dividends. So after that, you are going to add your answers that you are going to get here. Then your answer will be your DPS, your dividend share. Okay, I'm not too sure which other indicators I'm forgetting here, but I think I'm forgetting net asset value. Net asset value, right? Net asset value. Net assets. Net asset is your total assets minus your total liabilities. What you get there is what is called your shareholders' equity. Your shareholders' equity. When you take your total assets minus the total liabilities, you get your shareholders' equity. That is why the formula of the net assets value says shareholders' equity. Shareholders' equity. Because in other words, our shareholders' equity is net asset. Total assets minus total liabilities is your shareholders' equity. Then you divide by number of shares here, number of shares at the end of the year, right? Because your answer must be in cents, then you must multiply by 100. Then you get your answer in cents here. How many cents do you have in your NAV? This is your net assets value per share. All right, allow me to go straight to the formulas and to explain what is it that is under each indicator. Okay, I'll be quick with this one. Right, this is the formula for our our percentage gross profit on sales. It indicates total selling price greater than cost price. So the decrease in this ratio ngenzeka kube competition mangabe increasile, it's because of competition. Remember, our sales rate they will increase when there is a competition. So our gross profits also may be affected. So also there is inflation, which may affect our gross profits because we are now buying our goods at a higher price, our cost of sales. If it is higher, then our gross profit will be affected. Now, also the increase in fuel prices. Remember, petrol are now and again, so this will increase also the cost of sales. If our cost of sales is increasing, the gross profit will be affected. Reduction in the selling price to sell the product, and so on and so on. And then we also have our markup. Markup percentage on selling price must be equal to our target markup. But if it's not equal to our target markup, then that can be due to the shrinkage. The shrinkage is the decrease of our normally our inventory is affected due to our errors. Products are not marked up correctly. These are also errors. There is theft occurring, which may affect our markup, but this one works better with a periodic inventory system where it is directly affected to cost of sales to or in markup yet. All right, we also have operating expenses. It indicates how much, not must, how much of sales used to cover the running expenses of the business. So we want this one to decrease at all times, as I was saying. All right, then operating profit on sales, it indicates how much of sales end up as our net profits or as our operating profit in the business. The net profit indicates how much of net profit is attributed to our sales. Then these are the return ratios as I was explaining them. I explained to Roche return that the shareholders have achieved on the money invested in the business. It must be compared with the returns that may be achieved in other financial institutions. And then in the EPS, which is earnings per share, it indicates the amount that the business has earned for every share that it has issued. So it's a net profit per share. So this is EPS, and then DPS, it indicates the amount the business has paid to each shareholders. So I said here, this formula might be wrong. I encourage you to use interim over number of shares issued during the time, and then also use final dividends over number of shares that were used up. Okay. Then I spoke about NAV, which is indicating the amount that the business would receive if it sold off its assets, total assets minus total liabilities. What is left is the shareholders' equity. Then I spoke about return on capital employed. I said it's the return capital employed provides an indication of what profits or earnings can be obtained with the total funds that was employed. So capital employed, I mentioned what it made up of the shareholders' equity plus your loan. Your loan is your non-current liabilities. Then we also have solvency. I spoke about solvency. It's indicating whether the business will be able to meet its liabilities. And then we also had debt equity ratio, which this ratio provides insight into the capital structure of the business. A ratio of 0.4 indicates that for every £1 capital invested by the shareholders, 40 cents was raised through long-term loans. Now, a lower ratio indicates that the business has a higher credit worthiness, meaning that we can therefore easily get or obtain more funding if we require. Then we spoke about liquidity. We indicated we have got current ratio, which checks or indicates where the business can meet its short-term obligations, which is your current liabilities. Asset test ratio indicates the test of how liquid the business is because it removes assets. Sometimes this one is called asset test ratio. If it's too low, the business will not be able to meet its short-term debts. We also spoke about debtors collection, indicates how long debtors will take to settle our accounts. Then we also have creditors payment period. It shows how long the business takes to pay creditors, right? So, and then return rate of stock turnover rate. How fast do we, no matter how fast is our stock is sold per year. So it's the number of times the issue time per year. So it's cost of sales over average stock. Average stock is stocks last year at the end of the year plus stocks are this year at the end. You divide by 2 to get the average. And then number of months stock on hand. So some of the indicators here, you will use them when you do in cash budgets, like your debtors collection period, your creditors payment period, and so on. And these ones are used mostly stock turnover rates and stock holding period when you do your inventory valuation. You must understand that. Okay. Above the collection period and no payment period, but that's fine because I explained it. All right, moving on to today's activity. Welcome to the students who just joined now. You are encouraged to ask questions. Mr. Mdleje is waiting for you to ask questions. Please do ask questions if there is an indicator that you are not sure about. He is there to assist you. Also, you are encouraged to sign the register. The link is the first pinned comment when you click on question and answer. Welcome again. We are now doing the accounting today, and we are focusing on interpretation of financial statements. Okay, so I'm done with this document here. So we're moving on to today's session, which is interpretation of financial statements. All right, so it says Siyabonga Limited and Freddy Limited. So there are two companies. It was the 35 marks, and then you were required to do this one in 25 minutes. Okay, so let me choose a color. Okay, so the information relates to, I'm not sure what is happening. Okay, please. Okay, everything is still fine. Okay. All right. So the information relates to companies which operates in the same industry. That will be Jen Court's own shares in both companies. So this is a shareholder who owns shares in both companies. Notes where comments or explanations are required. Indicators. And trends. So may I check what is happening this side? There is something that is going on. I'm not sure what is it. Okay, sharing is fine, recording is fine, everything seems fine. But if you don't see the screen, please let us know. There is a sound that keeps on coming, so we don't know where it is coming from. Okay, thank you. Let's move on. All right, note where comments and explanation are required, you must quote financial indicators with figures and trends to support your answer. Okay, 7.1, liquidity. Identify the company that is managing its liquidity more efficiently. Now we know that we have got AMA indicators under liquidity. Then it says quote 3 financial indicators with figures to support your choice. Right. So it says identify the company's liquidity more efficiently. Then it says quote 3 financial indicators with figures to support your choice. So this is our answer book this side, and then this is our information Gala. So our information, so we're quoting 3 indicators, but under liquidity. Right. So we know the indicators under liquidity. Now, Galapayan. So I'll just, they are grouped, all of them. These are indicators under liquidity. So a current ratio, as I explained it, it's acid test ratio, stock turnover rate, debtors collection, debtors average collection period. All other ratios are not liquidity indicators. So that's why I grouped them. And others are not given. So you can't comment on something that is not given. For example, there is no stock holding period. So you can't comment on stock holding period because it's not given as one of the indicators. We know that it is but we cannot record it. Our current ratio, we can quote it. So which company is, it says which company is managing liquidity better, right? So we look at the current ratio of Siyabonga Limited. The current ratio of Siyabonga Limited increased from 2,1 to 2,4 is to 1 in 2026. And then asset test ratio wabo is 0,8 and it's in 2025 0,8 is to 1 and it's decreased to 0,7 is to 1 in 2026, which is bad. Asset test ratio wabo decreased. And then stock turnover rate decreased as well from 7,4 times to 5,6 times. Now you can see ukuthi uSiyabonga Limited shows decreasing trend kuma indicators wabo. So it's not safe to choose ubani uSiyabonga Limited. Ufredi ratio of Ufredi was 1.25, and then in 2026 increased to 2,0 is to 1, which is good. Because it shows an increase. And then also their asset test ratio, it's improved from 0,9 to 1,1 is to 1. Also their stock turnover rate improved as well from 9,5 times to 9,9 times. They are, even though their debtors average collection increased, but it's about 34 days. It's better than the. So our answer here will be Ufredi Limited. So go over to which company is managing, identify the company. So when you identify, you mention that company. So I'll say here, Freddy Ltd. Freddy Ltd. Okay. Then you chose Freddy Limited. Wabale ama indicators okhuluma ngawo. Current ratio increased from, can't remember but we'll check it this side. Current ratio from 1,9 is to 1 to 2,0 is to 1. So from 1,9 is to 1 in 2025 to 2,0 is to 1, but there's no need to say 2,0, just say 2 is to 1. It doesn't matter even if you say 2. Okay, now current ratio, as you can see, where is the trend here? Ngoba ithe question, you must quote financial indicators. So you quote indicator, current ratio. Ikhona yini trend? It's from 2. But if we are going to see current ratio increased, current ratio was 1,9 in 2025, and in 2026 is 2,0 to 1. There is no trend up. Yes, there is a current ratio, which is the indicator of quoted. Kodwa ayikho trend. Ngoba wena vele wathi nje awushongo ukuthi increased, awangasho decrease or improve or decline. When the current ratio in 2025 was 2,5, in 2026 was 1,9. There's no trend. Then you are not going to get full marks if you say so. So you must indicate the acid test ratio. You are identifying in Lapana indicator. You are quoting the indicator, the financial indicator with figures to support your answer. So acid test ratio. Any indicator of the quote Lapana increased from. Okay, this is a trend. Like you mentioned now, from 0,9 to 1,1 is to 1. So from 0,9 is to 1 in 2025 to, this is a trend. Make it increased from 2. It trend from 0,9 is to 1 in 2025 to 1,1 is to 1 in 2026. 2026. Nana nguphala 2026 in 2026. So you continue like lapha indicate. So you move on to any indicators ngayibala laphana. It is going to be stock turnover rate. I wouldn't choose debtors average collection period. Go about increase from 32 to 34 days. Truth manje, we are taking more days to receive or to collect from our debtors. So it's not safe to choose debtors collection period, even though it is better than that one of Siyabonga. So I'm going to choose the stock turnover rate to increase from 9.5 times to 9.9 times. So stock turnover rate, which I mentioned earlier, this one shows the number of times we have changed our stock. So if the number of times has increased, it means we are selling. We keep on going back to the supermarkets, to the warehouse to buy more stock for the business. So stock turnover rate also increased from 9.5 times to 9.9 times in 2026 and 2025. So who's going to work 6 marks because there are 3 ratios, there is a trend, and there are figures. All right. Don't say current ratio increased, then there are no figures that cause wash. So it says indicators, figures to support your answer. There must also be trends. Okay, let us look at the second question. What are they saying in the second question? In the second question, says return earnings, dividends. Return earnings and dividends. Explain whether shareholders of Siyabonga should be satisfied with the earnings and returns on investments, right? Earnings will be your EPS, earnings per share, and then your return on investment, which was ROCE, that must be compared with interest on fixed deposit. So you return on investment as well as earnings. About this commenting out lapana. Again, I like information yami earnings per share. So earnings per share, did it increase or decrease? But here Siyabonga esikhuluma ngawo lapana. So therefore, because now to explain whether shareholders of Siyabonga should be satisfied with any earnings and returns on investments, codes, figures. All right. So earnings in 2025, earnings per share decreased from 112 cents to 99 cents. This indicates the decrease in profit. I guess manga shares. Was there a change in the number of shares? Now, la company there. There's a decrease in profit. The number of shares now for Siyabonga in 2025 was 1,800,000. In 2026 was 1,800,000. All right, there was no change in the number of shares. But here, more earnings are decreased from 112 cents to 99 cents. That's what we are going to say here. Earnings per share or EPS, earnings per share decreased from 112 cents. Is it 112? Yes, 112 cents in 2025 to 99 cents in 2026, which shows the decrease in profits. It's indicating a decrease in profit. You can add that point as well, or you can leave it like this. That is fine. There is also another point that we must mention. There is also ROCE that they said must talk about. Now, looking at ROCE, I said that ROCE is a return on investment. The shareholders chose to invest in our business. I-return ke inzuzo abayitholile ngoku-investa in our business. So ROCE ubani? ROCE is return on shareholders equity. There is only one company that we're looking at. Ubani? Siyabonga. Now, the company we're looking at is Siyabonga. The question is on that. So ROCE decreased from 9.2 to 8.3%. That is what we are going to mention. Allow me to abbreviate. So I will say ROCE decreased. There's something I will explain here, which is very important. Roche decreased from, right? Decreased from 9.2%, 9.2% to 8.3%, to 8.3%. By how many percentage points? Okay, this is what we are going to look at here. 9.2 minus 8.3 is giving me 0.9. So we'll say by 0.9 percentage points. Or you can say by 90%, by 90 basis points. Now, I want to explain something very important. I won't continue without explaining this here. All right. Now, you saw on that one, I'll go back to that question. We saw that one, we had 9.2% increased to, decreased to, did I say increase? Decrease, yes. Decreased to 8.3%. And then I mentioned something like this was a 0.9 percentage points, 9 percentage points, or it's a decrease of 90 basis points. 90 basis points. This is what you can mention in that question. What is a basis point? Why am I mentioning this? It's the first time maybe you are hearing about it. But in March paper, you will remember we were required to mention this in our paper. All right? If you did not mention that, you were getting your answers wrong. Now, you would either say the difference between this is 0.9 percentage, but this is a percentage point, not it is just 0.9%, but this is 0.9 percentage point. It decrease, and then why am I saying 90 basis points here? It's because 1% is equals to 100 basis points. 100 basis points, 1%. If we've got 0.8, 0.8 is 80 basis points. My basis points per manje. Why ngithi ama basis points? Ngoba once yaba less than 1%, it is no longer a percentage per se, kodwa it is now a basis points. Uma ngabe uzobiza ngokuthi 90, ngeke ukuthi 90% lo, but sekuzoba manje yini 90 basis points ngoba isi less than a percentage. There is what is also is called here the relative increase and decrease. All right, relative increase and decrease. Now, as our indicator, which is Roche, decreased by 0.9 percent, 0.9% points. What was the relative increase or decrease here? How to calculate that? Ngiyabona ukuthi ukusuka lapha ku 9.2% ngiye ku 8.3%. Yebo umahluko ubani? U 0.9%. Kodwa ke manje, what is the difference? What is the relative decrease? Kube ubani percent ukusuka lapha ku 9.2% siya ku 8.3% relatively. So this is what you are going to do ke manje. You will take 0.9% divided by before it decrease lesitholile. So ekubani oku 9.2%. Then you multiply that by ubani 200 over 1. So when you say 0.9, I'm gonna go back to the question paper, but sorry, 0.9 over 9.2. Is it giving me times 100? It's giving me 9.8%. So this thing decreased by 9.8%. This is a relative decrease. This is a relative decrease by 9.8%. Not ukuthi kusuka la ngiya lapha kube 9.8%. What I'm saying, this is a relative increase. What is the difference? The difference lapha over before it decrease ibubani 9.2. Then in percentage, the relative increase was 9.8. So I hope we trying to say here at some point you may use or you may use the difference, which is the basis points or the percentage points. All right. So going back, again, our answer was Russia decreased from 9.2% to 8.3% by 0.9 percentage points. Now, what is the alternative investment? Is this 8.3 is now njengamanje? Lo. Is it above or below interest on fixed deposits? Now, our interest on fixed deposits, not. I said to you, we will compare Ubani, we will compare Uroshe with Ubani, with our interest on fixed deposits. Now, our Roche is 8.3%, but our interest on fixed deposits is 8.5%, right? So, this is below interest on fixed deposits. This is below interest on fixed deposits of how much? Of 8.5%. Because you must mention who interest on fixed deposits in percentage now, so that you have a strong point, because the answer says, or the question says, we must quote figures. So this is your answer, which was earnings per share in 2025 to 99. And then Russia decreased from 9.2% to 8.3% by how many points? By 0.9 points. This is below interest on fixed deposits of 8.5%. Shareholders will not be satisfied. You can also add that here. Shareholders will not be chose to invest in fixed deposits. But in our business, they are getting about 8.3% on their investment. Right. The next question on this one, it says, the next question is asking us to explain. The question there. It was this one. Okay, now we are here. The directors of Freddie Limited changed their payout policy. Explain this change. Basically quote figures. They changed their dividend payout policy. Now, dividend payout policy, I'm going to check formula number information yet. Now, dividend payout, we calculate it if it is given. Now, for both companies. So, if you're looking at that, the directors of Freddie Limited. So that means now we are no longer looking at Siyabonga, but we're looking at Freddie Limited. They changed their dividend payout policy. Right. Basically, it explained this change. Figures. So the dividend, how do you calculate it? I will show you the formula. If it's not always given. Sometimes the question paper will ask you to calculate the dividend payout. So this will be the DPS over the DPS over EPS multiplied by 100. We'll make an example. Now go for it. 83, which is their earnings per share. No 79, which is their dividend per share. Let's check if we are going to get this. So 79 over 83 multiplied by 100. Just to prove to you that you can get it even if you are not given. You are asked to calculate it. But now you were given. You are just asked to comment on it. So, but sometimes you are not always asked to comment on it alone, but you are asked to calculate it. So 79 over 83. You can punch your calculators. I'm also 95%. Is true. You can also check the other ones as well. So if you don't know how to calculate it, that is the formula: DPS over EPS times 100. Okay. Now, in 2025, the dividends payout rate was 51%. And in 2026, it was increased to 9. So it's commented upon the dividend payouts. All right. In 2025, The dividends, if this is cultivate 25, the dividends pay out 51%, and it increased to 95% in 2026 by ubani. 95 minus 51 is ubani by 44%. Okay. Now this is it. The directors of Freddie Limited changed the dividend payout policy, expected change, and quotes over figures. So this is what is happening. It's increased. So this is how we're explaining this change. No, sorry, it's increased from 51% to 95. 44 percentage points by 44 percentage points. That's what you also can mention. Then it says, explain why you consider this change to be either a responsible or an irresponsible decision. Then basically we are explainer, Lapana, or you provide 2 points. Okay? You provide 2 points. Now, when you look at this, when you give our shareholders, Lapana, Ubani, 51%, for example, in 2025, as you can see, they were saving around about 49%. When you say minus 51%, 49%. So you can say that the company as a responsible change. It's either responsible change or irresponsible. So you can choose which one do you want to choose. Towards a responsible change. Right? If you choose responsible, you will mention the first point that you can mention is that the company increased the dividend payout. The dividend payout rate to please or satisfy the existing shareholders, right? That's the first point that you can mention. And then the second point that you can mention is that the business, they want to the new, they want to attract, they want to do the panel. Moving on to the next one, Jen feels that going on to this question in the let's read the question from the question paper. It says that Jen, remember, is our shareholder, right? Feels that the dividends he received in Freddie Limited is better than that of Siabong. Speakers and explain what opinion. Jen feels that Pezolapana he received in Freddie Limited. Dividends received in Freddie Limited is better than that of Ubani Usiabonga Limited. Basically, it quotes figures and explain why you support his opinion. Right. Now, when you look at this question in Apana, we are going to look at ama dividends. Ulukuzana anao kwa information yet. Ama dividends anao. Ujen. Okay. The question is looking for La Pagubani. Ujen feels that on both of them feels that he received in Freddie ama dividends also are better than Lawa Agasiabong. So let's look at what he got. Now, in this question, how would you tackle this question? You would compare ama dividends with NAV or the market price. Okay, Kanja, Gogut City, for example, what was the NAV? Its dividends yield. So when you take 85 shares that he got from Ubani, That other company, 85 over NAV, which is Siyabonga. All right, 85 from Siyabonga, then divided by NAV of 1,195 times 100. I guess more in percentage, you would get the dividend yield, 85,195 times 100. So the dividend yield here that it got was 7.1%. This is Siyabonga Limited. But for Freddie, under Freddie, let's see what was the dividends. It was 79 dividends per share. 79 over NAV, which is 932 times 100 over 1. 932 times 100. The answer that I'm getting is 8.4%. So you can notice ukuthi laphayana the dividend yield that he got from ubani Freddie is greater than the one that is got from ubani uSiyabonga Limited. That lawa aka-Freddie they are better, but there is a student who would just say uSiyabonga is better. That will be wrong when you are just looking at these numbers. This is why you must then do what is called the dividend yield, so that you would see the real figures when it comes to the percentage. So when you say when you are just looking at 285, you may be wrong by saying, okay, ngoba nje ama-dividends aka-Freddie awu-79 cents, ngala awu-85 cents, therefore kaSiyabonga good, bese wena uyavumelana lokho. That may be wrong, because the question is already saying that uyafeel ukuthi lawa aka-Freddie they are better. But when you look at the information, hayi uyabuka ukuthi ngeke uFreddie bancane ama-dividends wakhe, yingakho-ke you are going to look at the dividends yield laphayana-ke ukuthi u-dividend yield yakhe when you comparing ama-dividends awatholile, compare it with the NAV. So dividends over NAV from both companies, you will notice ukuthi kahle kahle vele uyena uFreddie who is better. Okay, so your answer ke laphana would be you'll be saying you support his opinion, angithi uLokhuzana. Yes, uFreddie is better. Freddie is better. Then you are showing laphana dividends yield. I know your teachers may say something else with regards to this one. There are many ways in which you can mention dividends yield for ubani uSiyabonga Ltd was 85 cents over money over 1,000. How many? How much was it? Over 1,195. 1,195 was ubani 7.1%, and kaFreddie ubani 8.4%, which is 79 over 932. Right? So this is what you can mention. The NAV as well as ubani dividends, so that you could see which they are better. Risk and gearing. The next one will be risk and gearing. I think I mentioned kakhulu when we're looking at risk. These companies, that's what I spoke about, risk and gearing. So here that we are looking at. All right, compare the risk and gearing of each company and explain which company is managing their debts more effectively. Then you quote in financial indicators with figures. So that is for 6 marks. Which company? So we are going to look at we're comparing risk and gearing of each company. You explain which one is better. So we'll say that at the end. Firstly, we'll just compare these 2 companies. Okay, let's start with Siyabonga. Our answer sheet is given like this. Siyabonga, we'll look at debt equity. With debt equity, no gearing work on. Debt equity ratio. Now saying the ratio, right? Debt equity ratio. Asibheke lapha ukuthi ke increase noma decrease when you look at the figures. Okay? Debt equity ratio, ngicela ucishe nje laphana so that sizokwazi ukuthi sibone kahle. All right, so debt equity ratio. That's ekuqaleni laphayana for uSiyabonga. Okay. Increased from 0.2 is to 1 to 0.5 is to 1. Okay. Debt equity ratio for Siyabonga increased. Siyabonga is not written for us. We don't have to repeat that. So increased from 0.2 is to 1 to 0.5 is to 1, which shows an increase in risk. Or you can mention just straight up that it shows high risk. Because I said from 0.5 clearly, then you can mention that it is high risk. The next parts that you need to comment on will be ROTE, return on total capital employed. I think I said a lot the panels come to ROTE, that this indicator, it shows that are we managing our debts efficiently in the borrowed funds. That's what we're going to look at Lapan. Firstly, we compare, right? From last year to this year. I'm gonna see how am I going to comment? Please enjoy the comment so that it will assist you. It's decreased from 13.4 to 11. Right. ROTE increased from 13.4% to 11.9%. Yes. Right. So it's decreased from 13.4% to 11.9%. By how many basis points or how many percentage points? Right? 13.4 minus 11.9 decreased by 1.5 percentage points. Now, the next thing to check is to compare. It's 26 to 11.9. The next thing to check is the interest on loan, so that you can decide, is this positively geared or negatively geared? Right. Not geared, positively geared, but positive gearing and negative gearing. So interest on loan was 12.5%. Yona yehlile from 11, from 13.4 to 11%. So this is below the interest on loan of 12.5%. So yabhala phana ke ukuthi, and this is the interest on loan of 12.5%. Now, as big as negative gearing, no positive gearing here. 11.9 minus 12.5. So, you have to put negative and positive in. 11.9 minus negative 0. Negative gearing shows negative gearing. Yeah, shows negative gearing. Simple. Done. Right? Because it's showing when you compare ROTE minus interest on loan, it's showing a negative gearing. Freddy, sibheka uFreddy lapha ukuthi kwenzakalani ke namanje. Their ROTE lapha kuFreddy is 9.8% and their improver yaya kubani 13.4%. Siyabhala lapha. Siqala nge-debt equity ratio ke okwamanje. Asiqala nge-ROTE. Siqala ngo-debt equity ratio like leyana phezulu. Debt equity ratio for Freddy. Let's look at the debt equity ratio. It was 0.6. It was high risk in 2025. Yes, that's 0.2 is to 1. So I started upon and said again, debt equity decreased or improved. Improved, okay? Decreased from 0.6 is to 1 to 0.2 is to 1, which shows low financial what? Risk. Which shows low financial risk. Okay. This is the first part. And then the second part, when you're commenting on risk and gearing, we mention debt equity ratio as well as ubani ROTE. ROTE. What is happening in ROTE? What's happened? Did it increase or decrease? Big trend, what happened? It's decreased from 9.8 to 13.4. Increase, sorry. ROTE increased from 9.8% to 4%. 13.4 minus 9.8, which is giving me 3.6 by 3.6 percentage points. Right? That's what we mentioned about by 3.6 percentage points. The next thing here is to mention positive gearing or negative. Interest on you 12.4. Let me double check. The interest on loan was 12.5%. Yes. So 12.5%. Tala ngumanaza ini lapana, tata ini urote 13.1 this year. The interest, okay? 13.4%. 4%. Spare is positive in my percent. It is 0.9. This amount is positive. So this shows positive gearing. This shows positive gearing. Done with this one, okay? It shows positive gearing. Why is showing positive gearing? Ngoba uROTE is greater than interest on loan. So that means we are making good use of loans. So we got 1 kilo 6 bucks lower. All right, then 7.4. It is share and shareholding. Freddie lost the majority shareholding of Freddie Limited because additional shares during the financial year. Why lose in shareholding yake? Explain why he wants to maintain his position as the majority shareholder. Remember, to be majority shareholder, he must own 51% of shares. Now, why would you want to maintain your shareholding in Apanage? 1 point. That is because he wanted to have influence in making sorry, what's influence? Okay, I'm trying to influence in decision making, or you wanted to take major decisions for the company, wanted to have full control, full control or influence the decisions of appointing directors, CEOs, and so on, CFOs as well. So that's why you would want to become a major shareholder. To be a major shareholder, it means when you are holding the highest number of shares in that company. So if we have the highest number of shares in the company in terms of percentage, it means when you have what is called more voting power. That is another reason. We have more voting power because every time we vote, it must be taken. It's taken based on what the majority is saying. So if the majority is 51%, all the others are sharing 49%. So vote, this one will always win because shares they are greater than oma shares wabanye combined. That is why the major shareholder and a greater influence over others, because every time there is voting, no matter every time there has to be decision to be taken, they have more say lapana ngoba they've got the great number of shares. Right. Calculate the number of shares that he must purchase to achieve this objective. The amount he'll require to purchase the shares now. So I'm going to assist you with this one. Let us look at the question, the information. Now I got a question ufred yangithi ukuthi-ke iyehlile ilokhuzana shareholding yakhe. If you can quickly look at the shareholding yakhe ukuthi iwubani njengamanje. So you can say ama-shares awa-ownayo awu-920,000 over the total number of the shares in the company awu-2,080,000. So let's times 100. Let's see how much is this. 920,000 over 2,080,000. Then here I'm getting times 100. I'm getting 4%. So kusho vele the time the company issued more shares from 1,700,000 to 2,080,000, you would see ukuthi uFred was affected by this. Ngenxa ukuthi yena azange azawathenga anyukile from 1,700,000 to 2,080,000, but yena awakhe remained at 2,000. This is why i-shareholding yakhe was affected from 54% yaya kubani ku-44% by 10.9%. So yehlile i-shareholding yakhe, as you can see. So the question is asking us to calculate the number of shares that he must purchase to achieve this objective and the amount he will require. Okay, now the company is saying that shares amangaki manje 2,080,000. Now, to be a major shareholder, I said you must own 51%. I know there are many ways of calculating this, but I will show you currently like 51%. So the company has got 2,080,000 shares. Now, if you take that one, ukuthi usafuna ukuba a major shareholder, kumele hold the shares of 51%. Aswabale mangaki ama shares awadingayo 51%, some 51 over 100. So lokhu sinikeza bani 2,080,000 times 51 over 100. Kusinikeza 1,060,800. So already unawo ama shares awu-920,000. Mangaki awadingayo ama shares? 1,060,800 minus 920,000. Lokhu 1,040,000. Sorry, 100. The answer here when you are responding to where I wrote it, so it was 2 million. Then you multiply this by 51 over 100, and then to get the total 2,080,000 times 51 over 100. Then you're getting 1,060,000. Sorry, 60,800. Okay, minus 920,000 shares. Then 1,800. So now how much? It's and the amount shares athengwa ngemali kwi-market price. So how much is the market price for Lama shares in this business? So here's the market price on the stock exchange. They are 9.45 cents. 945 is 9.45 cents by 9.45 to get malina aitingai. So 140,800 times 9.45. It's going to be 1,330,560. This is the price he was going to pay if he decided to buy Lama shares now. Because Abe major shareholder. All right. The basic question again: what advice would you offer Freddy about his shares in Siyabonga Limited? Provide 2 points. What advice? I know in the question paper, if I wrong, the question paper in the question paper, let me just open it so that it's going on. It's on Siyabonga, question paper it's on Fred. What advice would you offer Freddy in his shares in Fred Limited? It's not supposed to be Fred, it's Siyabonga. Offer Freddy about his shares. ilokhuzana futhi again uFred, it was uJen ilokhuzana uFred was a company benosiyabonga, but uJen was a. So my question, my mistakes are in my question paper. What advice to offer this person? Bonga Ltd. The advice would be to sell his shares. Ngoba we are born upon which they are not making much. So ungatlapana sell his shares in Siyabonga Limited. Right? Since they are making in Roche, Ubane, only 8.3%. Then point number 2, invest in other companies or in interest, in fixed deposit, in other companies or in fixed deposit. So fixed deposit is going to give him Ubani or 8.5%, not the 8.3% is getting with the company Siyabonga. Right, so it was Jen, supposed to be Jen here. All right, the question is done. So this is a question here too. Yanamhlanje ebesiyenza kule paper lethu le KZN visual document, and then now we're moving on to another question. We will see that it's almost the same what we will be doing here, right? So on this one, it was on. This question was on May June examination. Yeah, 20. If you don't have it, we'll download it so that we will follow when I'm doing this question paper here. Now, again, it says interpretation of financial statements. Interpretation of financial statements of financial information, not statements. The information relates to Bright Sun Limited. The company sells high quality solar panels to businesses and to homeowners. No solar panels. 28 or 29 February, understanding. If we have a leap year, we are paid go 29 February. And required, where comments or explanations are required, you must then quote financial indicators and trends with figures. And then you give a reason for, or give a reason or an explanation on the relevant financial indicators. I'm reading this form so that all of us understand. We see when we are commenting and quoting figures, we must quote indicators in every time. Then also for relevant indicators. Okay, I think we have a problem with our network, but it's going well. Okay, it's not clear screen. Okay, thank you. All right, 3.1. Markup percentage. Explain how the customers reacted to the change and whether this benefited the company or not. Okay, so we will look at markup lapana, but markup and how the customers reacted to the change in markup. In markup is a profits added on the price, or on the cost price. So it's added on the goods markup. So we should say, if for example our markup is 40%, it means on the cost price we will add 40%. Normal, if the markup is 60%, on the cost price we will add 60%. Kahle markup is a profit. If you want to sell this, if you buy this bottle for 5 rand and then you sell it for 10 rand, your markup is 5 rand. So you are adding. Now, if you change your markup, you are going to increase it. Normal, you are going to decrease it. Now, if you increase your markup, this means that you increase the profit you want from each product. If you increase the profit you want, the product will be more expensive, which may react in a certain way, run away, or they may stay in your business and support you. But remember that if it's too expensive, customers run away. They find among our businesses that sells this similar products. So we'll have to look at the behavior of our customers with regards to this. Did our company benefit when there was a percentage change in our markup? We'll have to analyze or interpret these figures again. My figures, they will tell us what happened to our customers with. Okay. All right. Okay, I'm looking for duplicating screen here, so for me to be able to view. Okay, please give me a second. I need to duplicate the screen. All right, thank you. So that on this side, I can keep on scrolling. Okay. So here are my questions, and then here's the information. All right. So we have our information here. Here is the markup, as you can see. Markup increased from 40% to 60%, meaning that the price of the goods are now more expensive. How did the customers react to this one? Quotes, AMA figures. Now look at the number of customers. Don't look at the number of directors. That has nothing to do with this year. All right. Who's my customers here? With what happened? So this is our customers decreased from 80 to 145. Okay. So this will be answer is Kalapana. Customers. Number of customers decreased from last year we had 208 customers. This year we've got 245 customers. 280 from 280 to 245. By how many customers? If you look at that, at this 280 minus 245 by 35. Okay. And also average sales per customer increased from 120,000 to 160,000. Even though our customers, as you can see, they decreased from 280 to 245, but the average sales per customer increased from 120,000 to 160,000. So what does this mean? It means that our sales increased. All right, so I will show you how sales here. All right, so can just mention here that the customers, the average sales increased by 40,000, which is by 40,000, which is 160,000 minus 120,000. It's increased, as you can all see here. Now it means that how much is our profit? If you can say, because since customers now are 245, so say 245 times 160,000. This will be the profit for 2026. So for 2020, okay, 245 times 160,000. This is giving me 39,200,000. This is a profit for this year. Then last year there were 280,000. 280 my customers. Were 280. So 280 customers multiplied by 120,000 average sale per customer. So 280 times 120,000 is 33,600,000. Now you see, last year we made a profit of 33,600,000. This year we're making a profit of 39,200,000. So the company is benefiting. You can mention that point here, which sales increased from 33 million to 39 million. So that also can be your answer when it comes to this. We're done, Lepano, get your 4 marks. So the company benefited because the number of customers decreased, but even though number of customers decreased, the average sales per customer increased. So, which is good for the company, but they made more sales when compared to last year, even though the number of customers decreased. So 3.2, profitability and operating efficiency. Profitability. Remember, I said earlier, profitability is how well the business is controlling, not controlling, but are we profitable as the business in? Operating efficiency will be your operating expenses as well as operating profits. Comment on the operating efficiency of the company over the past 2 years. Quote 2 financial indicators. So picking up under profitability indicators, but profit or operating efficiency. So these are the indicators you can mention. Operating expense on sales. Look here, it's decreased from 28 to 22. Okay, so this is what you can mention. Uti operating. Okay, let me increase the screen some. Yeah. Operating expenses. Expenses on sales decreased from 28% to 22% by how many percentage points? 28 minus 22 is 26%, by 6 percentage points. Noma usho relative decrease. So 6 difference over before decrease over 28 earlier multiplied by 100 or last year. So 6 over 28 times 100 is given 21.4%. Uti by is decreased by 21.4%, which is a relative decrease. So please do also speak about this one when you're commenting on your indicators. Relative decrease is 21.4%. More than the 40 usho ubani 6 percentage points. But you don't have to say basis points. You don't have to say basis points. Just say 6 percentage points. But then if you decide to use the word basis points, then 1% is equal to 100 basis points. Then you would say here 600 basis points, not 6 basis points. 6 basis points is 0.06%. Yeah, 0.06%. This is 6 basis points. 1% is 100 basis points. So this is 600 basis points if you decide to use that method. But it is not compulsory. You can say 6 percentage point. That is what you can say when you talk about this. And it's an alternative. If you like to say a decrease from 28% to 22%, it's an alternative for saying 6 percentage points. Norma uti by a relative increase, decrease 21.4%, because in this case it's decreased. Then we move on to the next one. Operating profit on sales also increased from 10.2% to 15.6%. Right. So operating profit on sales, so operating profits on sales. Ngicela ubuze laphayana kuMr. Mdletshe, type your answer on question. Don't understand what I am saying. So sales increased from bad. Let's look at this one here. Increased from 10.2% to 10.2%, 15.6%. How many points? 10.2 minus or 15.2, which is the bigger number. 15.6 minus 10.2 is 5.4. So by 5.4 percentage points. 5.4 percentage points. What was the relative increase Inyongo bani ke ilokhuzana kahle kahle in terms of relative increase. So it will be 5,4 over before increase, which is 10,2 times 100, so that you can get the percentage of the relative increase. 5,4 over 10,2 multiplied by 100 is 52.9%. So this increased by 52.99%, which is very good for the business. Very good. This is our operating profit increased by relatively. So this is your alternate. All what I've been saying here, Lapayana, these are the alternatives which we can raise your number, present your answers here. So by Bani O increased by 52.9 percentage point, 4.9% relative increase. So that is it that you can mention, Lapaya. All right. The next question, done with this one, you get your 4 marks. You can also mention, you can also mention net profits after tax, even if they said they want operating efficiency, even if they wanted operating profit, operating. So you can mention net profit after tax, which is 8,8, a decrease, an increase of 8,8. 13.5%. Nakhona futhi ungabala phana ukuthi ke by how many percentage points increase ngawo. So 13.5 minus 8.8 is ubani 4.7. So it's increased by 4.7 percentage points. This is an absolute increase. Then a relative increase. So abuka manje ukuthi 4.7 over before increase oku 8.8. What was the relative increase on this one? So abuka lapho, oh, okay, the relative increase is 53.4%. That's what else you can mention on this one. So it was also an alternative. You can mention all 3 of them, but they wanted 2. You can mention all 3 of them. It's fine. You will not be penalized if you mention 3 indicators, right? But better to have more than to have less of what they wanted. So 3.3, financial risk and gearing, right? Remember I spoke about I said risk, debt equity ratio. Then gearing, that must be compared with what? Interest on loan. One of the shareholders cannot understand why debt equity ratio increased in 2024 despite an increase in the loan. I think here they wanted to say decrease. They wanted to say decrease. I'm not sure whether there was an errata or what, because the reason why I'm saying that there's supposed to be a decrease. It because debt equity ratio did not increase. I see again. Now debt equity ratio. It decreased from 0.3 to 0.2 is to 1. But the question is saying one of the shareholders cannot understand why the debt equity ratio increased in 2024. Look at 2024, it's decreased now from 0.3 to 0.2. So I don't know why the examiner here used the increase instead of decrease. It decreased in 2024. Okay, but nonetheless, if you put decreased here, I must put a disclaimer on this one. I am not sure whether this was an error or not, right? I'm not sure. I must put a disclaimer up front with you. Please, I do apologize if it is correct to have increase here. But in my understanding, we are not supposed to have increase here. We are supposed to have decrease, because when you look at the figures, it's decreased in 2024. So let us work with decrease and not to increase. Okay, so it's decreased in 2024 despite the increase in the loan. So loan increase would expect to debt equity ratio after increase, but in this case, decrease. Provide him with an explanation. This is because of an increase. For example, the property 1 point, it may be because of the increase in shareholders' equity. Increase in shareholders' equity. All right, the increase in shareholders' equity may be the reason why debt equity ratio decrease despite the increase in loan. Yebo, so kunyuke ubani equity the loan futhi yanyuka nayo, so okwenza ukuthi ke debt equity ratio wethu ashone phansi. Okay, moving on to the next one. The next question is the next question lapha. The CEO, the CFO, which is the Chief Financial Officer, is of the opinion that the increase in the loan was a good decision. Apart from the debt equity ratio, provide 2 points to support his opinion, including one relevant indicator. But asengayifaki i-debt equity ratio ngoba sebebenitshelile phela ngaphezulu. Ake siyobhala laphana ke sisho ukuthi ke eyiphi enye indicators ngayibala. Mina kwami uRotse. Ayikho enye indicator ngayibala laphana. uRotse okhuluma ngani ngeloni ngoba he said uRotse is about making good use of loans. Now when you look at uRotse, bathe 2 points angithi siqala ngokuthi uRotse ke manje to make it 2 points, we'll start by comparing uRotse ukuthi increasile from 11 to 19.7%. Then our second point, we are going to mention the difference between interest rates on loan as well as uRotse to state whether there is a positive gearing or there is negative gearing. Let's start. Right. The point number 1, ROTE, which is return on total capital employed, increased from, what was the answer here? It was from what? Now, from 11%, which is 11.0%, to 19.7%. Now, to 19.7%. By how many percentage points? 19.7 minus 11 percentage points by 8.7 percentage points. Right. Or relative increase, 8.7 divided by before increase divided by 11 times 100. Then the answer is by 79%, 0.0%. Right? Go 79% lapana uRotse. So that's a big increase. uRotse and Nyuengao. The next point is where we're going to compare uRotse with the interest on loan. Okay, so that you can mention in the negative gearing or positive gearing. How much was the rate on loan? It was 13%. Now the percentage rate on loan, 13%. Okay. All right. So you can say ROTE of 19.7% in 2024 is above interest on loan of 13%. Let's pay negative gearing in 19.7 minus 13%. 19.7%. So 19, which is the ROTE, 7 minus 13%. I'm getting a positive amount of 6.7%. So you are showing upon this shows it's positive. This shows a positive gearing. This amount is positive, right? No, this percentage is positive. This is why you are saying here it's positive gearing. But if your ROTE was 13 and your interest was 19, you would get 6, which is negative. Then you say negative gearing, right? So in this case, the amount is shown like this. So it's a positive gearing. Done with 3.2. Right, 3.4.1. Comment on whether shareholders should be satisfied with the return on their investment. But again, firstly, I said we must read the question from the question paper. Right, it's also disadvantaging sometimes to read the question from the answer book, because sometimes we miss a lot of information that they would say in the answer book. All right, 3.4, returns, earnings, and dividends. Comment on whether the shareholders should be satisfied with the return on their investments. All right. Provide 2 points, including one financial indicator. Now, I mentioned this earlier. If you were listening attentively, I mentioned that we need to look at UROSHE when we want to check ukuthi ama-shareholders wethu, are they satisfied? ROSHE must then be compared with interest on what? Interest on alternative investment. Right. Since they are saying 2 points here, Nana will do the same thing. First point is for us to compare ROSHE of the previous year and the current year. Right? Let's look at ROSHE. Return on shareholders' equity. What happened to our ROSHE? Our ROSHE increased from 8% to 15.6%. Right. ROSHE, siyabhala phana. ROSHE increased from, where's ROSHE? From 11%, from 8% to 15.6%. From 8% to 15.6%. What was the relative increase? Firstly, the difference. 15.6 minus 8. It increased by 7.6 percentage points. Or relative increase. So tini lapana manje 7.6, which is the difference, over before increase, which is 8%. It's going to be a very big difference here. So 7.6 over 8 times 100, I'm getting 95%. By 95%, which is a very big increase of our ROSHE. So it's increased relatively by 95%. Then let us look at the interest on the interest on alternative investment. So the interest on fixed deposits should be given here, right? It's 7% here. The interest on fixed deposit is 7%. Then you mentioned here, Nguti, ROSHE of 15.6% in 2024 is above in interest on investment. You ban interest on investment, you must mention it. Of investment of what? Okay, interest above interest on investment of 7%. Therefore, shareholders will be satisfied. This simply means that the shareholders, they decided to buy shares in the company. Then the company gave them in this year 15.6%. If the same number of shares, no matter the amount they had, they decided to go and buy shares elsewhere, to put it in the fixed deposit, they were going to get 7%. In our argument, they will be satisfied. Okay. Okay, moving on to the next question, which is 3.4.2. Comment on the earnings per share and explain its impact on the dividend payouts policy adopted by directors. Okay. Then on what they got, how much they gave to their shareholders. That's why they're saying impact on the dividend payout. All right. So the point number 1, we look at earnings per share. The earnings per share was, let me remove this, was 113 cents, and it's increased to 224 cents. Let's mention that. Right. EPS increased from 113 cents per share to 224 cents. That's the first point you can mention. Right. Then they decided, they are going to give their shareholders 80% in 2024. Then by decreaser to ubani 40% lapha dividend payout lapha to save for the future, right? So how much they gave their shareholders? Okay, they gave their shareholders ubani 40%, right? Maybe you can say that they retained 60% of earnings in 2024 for future developments of the company. Whereas in 2023, they focused in pleasing the shareholders by giving them 80%. Right? In 2023, they only retained 20%. Right? Most of you can say they gave their shareholders 40 and but retain 60%. No matter the other way around. They gave their shareholders, they wanted to please their shareholders by giving them 80%. Retaining 20%. There are many ways of saying the similar thing. There are different ways of saying it. Okay. Moving on to the next question, which is 3.5. I think this is the last question in today's activity. So I ended up not being able to cover what I said I will cover. But since next week we are revising, I'm going to mention what I said I will mention later on, which was the weighted average number of shares. So we'll mention it next week on the 11th because we'll be revising for paper 1 since you're writing it on the 18th. So share price on the stock exchange. Comment on the performance of the share price on the stock exchange, JSE. Then you provide 2 points with figures and trends. Comment on the performance of the share price on the stock exchange. Then you provide 2 points with figures. The share price on the stock exchange. The stock exchange being ubani JSE, Johannesburg Security Exchange. Now, how are our shares? This is the market, market price. The market price. How are our shares performing in the JSE? That is what we will be looking at. So here, the market price is compared with the NAV. NAV is our price of our shares within the company. Then there is also a market price. If our business has a good publicity, it is going to show an increase in the market price because it means that our company is doing well and it is also welcomed well in the public. So that means that our shares are going to perform well in the market. But this is our price with Ubando with NAV. So this is why we are going to comment and compare Ubani market price as well as NAV. Firstly, it is crucial for you to compare the two, the market price. Market price increased, as you can see, from 1,342 cents to 1,610 cents in the JSE. Why would the market price increase in the JSE? This is because of good image, or it because of, as I was saying, the business is doing well. So it's good publicity. So this is why our market price increased, right? So the first point you mentioned, market price increase. Okay, the market price on the JSE increased from 1,342 1,602 cents to 1,610 cents. Okay, then bese mention laphana ukuthi ke this shows that the company has a good image. Can end there. Then the next one is where you can compare Ubanu NAV because there are 2 points. Then you can mention your NAV. Right. Then the market price of 1,610 cents in 2024 is above the NAV. Better to mention the NAV. How much was our net asset value per share? It's above our NAV of 1,543 cents. Of 1,543 cents, which shows high or good demand. Let's use good demand, right? Which shows good demand of our shares. Right. Then I don't think we have more okay, there is another question, Payana. Yeah, we do have more questions, but because of time, it's now 7 o'clock. We are going to cover these questions next week as well. So please do continue with these questions. We will cover them next week with 3.6 because this is the only question that is left in my question. So we thank you very much for joining us. We will see you next week. We'll start at 3.6 and 3.7, and then we'll revise for paper 1. So our focus again will be question 1 as well as question 2. Thank you for joining us and have a good night. Thank you.